Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of our Tuesday, Thursday news event videos. Big video plan for you today. Apple just sent out the invites to its September 12th Wonderlust event, big September event Apple has every year. Refreshing that product cycle could mean big news for shares of Apple, up to $3 trillion, or maybe even down 9% if the news fails to wow Apple investors. So we're going to talk about that. We're going to talk about a couple of other big news events over this last week and answer your questions. As always, if you've got a question, ask it in the Monday or Wednesday videos in the comments section. I'm going to address those. Make sure you're subbed to the channel, though, so I can answer those first. Before we get to that, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, click on the link I'll leave in the description below. It's a free report I put together with the Motley Fool, my 5 forever stocks. In fact, one is up 5% today alone. Look for that link in the description below. You're going to get the first stock immediately, then the other 4 by email. It's totally free, no obligation. It's a great way to get that free report and help support the channel. So I appreciate that. But back to our main topic though, because this Apple September event is always big news for the company. It brings a product refresh cycle that can boost the shares higher or bring them down lower if investors just don't see anything that's going to bring consumers back to the stores. We can see here that Apple shares are already up 50% for the year. It had a brutal August there, selling off upwards of 15-20%, but has recouped most of those losses. Even against that amazing run, though, we do see that it is still underperforming a lot of those FANG stocks. All but Netflix really here. Meta obviously having a huge year, up 150%. We have Netflix down there really closer to where Apple is. Apple is showing at about 44% higher this year. Netflix right about 45, 47%, Google up 55%, and then Amazon up 65%. So even that ginormous run so far for Apple this year off the last year's lows, it is still lagging some of its tech heavyweights. And against that stellar return, it can be hard to imagine that this wasn't supposed to be a great year for Apple. Here we are on the analysis tab in Yahoo Finance here. It shows analyst estimates for earnings as well as sales this year. And we can see that it wasn't supposed to be a very good year for Apple's earnings or sales. Sales are expected lower by 2.8% this year. That would be very rare for Apple to see sales fall from one year to the next, but 2.8% lower to $383 billion. Of course, they always beat those expectations. So I'm expecting a little bit more closer to 385, maybe $390 billion this year rather than that sales loss. It would still be a loss in earnings per share, though, expected to post $6.07 per share versus $6.11 per share. Earnings are actually expected to fall for the first time since 2019. Now, we do see some rebound next year, expectations for $6.61 in earnings over $6.07 this year, 6.3% sales growth to 407 billion. I imagine that's going to be closer to probably about 410, 415 billion. Might even be much higher on what I'm about to talk about next. Because again, remember, Apple is all about the product cycle. Okay, you get those ebbs and flows in the product cycle where the iPhone doesn't come out with any real big new refreshes, upgrades in a particular year, and consumers just decide, I'll wait till next year to buy more. Same thing with the iPad, same thing with the Mac. This yearly upgrade cycle is so important because it's going to either bring consumers back to the stores, boost those sales and boost those earnings, or it's gonna be kind of a lackluster year for Apple. What we've seen over the last couple of years is, yeah, it's been kind of lackluster as far as sales and or upgrades. So last year there wasn't a big upgrade in the iPhone or a lot of the other products. That's meant that 2.8% sales decline over this year. So this September 12th, we're going to see if they're releasing anything new, anything big in the especially the iPhone, but maybe also the iPad, the Mac, and other products to really bring consumers back and boost those sales for the next year. Again, Apple has sent out its invites for its annual September event this year on the 12th. It is expected to release the iPhone 15 with a USB-C charging port after the EU ruling last year that said that all phones and electronic devices had to have some kind of a USB charging port. Rumors are that they will also announce a new Apple Watch model, including an updated version of their Ultra Apple Watch. That simple addition of a USB port probably isn't enough for an iPhone refresh, though, and we're getting reports from other Apple reporters that aren't a whole lot of new additions here in this September event. We are possibly seeing no new additions to the iPad Pro here in this September event. Reports by Mark Gurman, he's an Apple reporter over on Bloomberg that's gotten the inside scoop below, is pointing to a new line of iPad Pro models in 2024, though, with big upgrades, including an OLED display, keyboard accessories, and a processor. That would be the biggest upgrade cycle since 2018 and could cause a trickle down of upgrades into the other iPad lines. Okay, so iPad Pro is their top of the line expensive model. Starts at about $800 without accessories. That usually sees the first upgrades in that iPad Pro model, and then that trickles down into like the iPad Air that could be updated this month with a better processor and a camera and is far less expensive. So what we usually see is that iPad Pro relaunch or the revamp gets all those new upgrades, and then those upgrades slowly trickle down to the less expensive models. What we're saying here is that if that iPad Pro model doesn't upgrade until 2024, it could be a kind of a weak couple of months for Apple enthusiasm and consumer sentiment if it doesn't bring anything out new. But it would be a good 2024 upgrade cycle with that new upgrade, as well as the idea that that's going to trickle down into these other iPad models. So as we're thinking about the different upgrades to the different product lines and how that's going to refresh sales and maybe the stock price for Apple, we want to look at really the sales breakdown for the company. So 52% of sales are from iPhones. That is why that iPhone refresh cycle is so important, so critical to boosting those sales. So that's really the product to watch for this upgrade cycle. Again, not seeing any big rumors for an upgrade cycle this September that could cause for a weak fourth quarter, that crucial fourth quarter Christmas shopping season. The iPad accounts for just 7.5% of sales. So even that big refresh next year in the iPad Pro and then trickling down into these other iPad models that could bring consumers back to buy new iPads, it's not going to move the bottom line or the top line very much. Mac is about 10% of sales. Wearables, another 10%. So that big upgrade to the iPhone Watch or the iWatch that we're going to see here in September, that could move the top line marginally, and services make up the rest, about 20% of sales there. So as we're thinking about that expected 2.8% decline in sales for Apple this year, 6% sales growth next year, we want to start thinking about valuation. Here we see on Morningstar the price to sales ratio. The current ratio here is at 7.8 times sales. And while it has been as high as 8.8, 8.5 times here in 2020, those heady days of the pandemic where everything was so expensive, it has been closer to about 5.3, 5.4, 5.3 here over the last couple of years, 2019 to 2022. If we go back even farther, you can see 3, 3.8, 3, 2.95, 2.6. Price to sales ratios very much closer to 3 rather than 7 or 8. So about half as expensive as they are right now. 5-year average multiple for price to sales has been about 6%. So well under that 7.8 times price to sales right now. On a price to earnings basis, we also see 31 times price to earnings. That's been an average of 25 times over the past 5 years. Again, that includes those heady days during the pandemic where it reached as high as 40 times price to earnings. So not necessarily a fair value price to earnings ratio there at 25 or even 30. We do see it was at around 21 times price to earnings, 24 times in 2019 and 2022. And then again, if we go back further, we can see it's been as low as about 10 times, 10, even 7.5 times here in 2015. Obviously, I don't expect it to ever get back down to 7.5 times on a price to earnings basis. If it is, you put your whole portfolio in Apple because that is terrifically cheap. But it probably shouldn't be up here as high as 31 times price to earnings either. But we want to put all this together to see how we should be investing in Apple right now. Of course, Apple dominates consumer electronics, so it is going to be a good long-term pick, whether the short term is weaker or not. We already know that the consumer is weakening from a lot of those retail warnings. We've heard from a lot of retail companies that the fourth quarter, third and fourth quarter expectations are extremely low. That's driven a lot of those stocks down. Christmas is going to come after that big student loan restart this year, so people are going to have to, for the first time in 2 or 3 years, start repaying their student loans. That could take another $5 billion or more off of consumer spending. That could weigh on the retailers, especially the pricey electronic retailers like Apple. Combine that with the fact that we really don't see much of a significant refresh cycle in any of the products this year. Maybe the iPhone watch, maybe a couple of the other ones. Obviously, we've got the iPad Pro next year, but really nothing from rumors or any wow product that combined with struggling consumers, that could mean that third quarter and fourth quarter sales are going to be weak this year. At a 7 times valuation, it is still expensive, especially given historical estimates or historical averages. With $385 billion in sales this year, obviously, I do believe they're going to beat sales expectations. They always do. But at $385 billion in sales at a 7 times price to sales valuation, which would still be high, but it'd be quite a bit lower from that 7.8 times it's trading at now. That would value it at $172 a share, basically back to our May price and about 9% lower from here. That said, next year could be significantly better for shares of Apple, but in a bigger refresh cycle. They didn't announce anything really last year for the iPhone. If they don't announce anything this year, I expect them to announce a big refresh cycle for the iPhone next year. That is going to bring investors back as well as consumers, obviously, with that iPad Pro refresh happening next year, as well as maybe something in the Mac line as well. I think that would really recharge sales for the company as well as earnings and really bring those shares back up. So I would hold off buying through the September event, maybe even the next earnings, which are scheduled for October 25th. That's when they're going to announce their third quarter earnings. They'll probably give an outlook for the fourth quarter, which, of course, if we see further weakening from consumers, that outlook might not be good, might send the shares back down even further, but then start increasing position there in January. Again, I think 2024 is going to be significantly better. I think you want to get in front of that before the rumors start happening for that refresh cycle and start accumulating shares before that happens. A couple other big news events this week. Big win by crypto this week as the Federal Appeals Court ruled in favor of Grayscale and its GBTC against the SEC. So Grayscale sued the SEC last year after it had denied ETF applications to convert GBTC into an ETF. The three-judge panels court agreed that the SEC is just really acting arbitrarily against GBTC and really a lot of these other ETF filers, since the regulator had already approved an exchange-traded product with futures contracts. Basically, they're saying that an ETF on GB or on BTC, on Bitcoin, other cryptocurrencies, is materially different from these futures contracts products like the GBTC. So there's no reason not to approve that ETF conversion. We saw a 6% pop in Bitcoin and BTC there, and double digits in related stocks like Coinbase, Marathon Digital, and Riot Blockchain. Of course, on that news, the industry is now hoping that the decision boosts chances for other ETFs by BlackRock, Invesco, others to be approved, really making it easier for investors and institutional investors to have a position in cryptocurrency. Again, we did see that big pop in Bitcoin on the news, as much as 8% at one point before giving back to some of that. Bitcoin has been relatively flat since that news, giving back a little on the idea that the SEC change may still take a while. Okay, the SEC has much more preferred to fine a lot of these cryptocurrency platforms and others, really being a cash machine for the Securities and Exchange Commission rather than making any real rulings or regulatory changes. For that reason, I'm not sure that I expect anything different from Chair Gensler or the SEC in a shorter period. I do expect Bitcoin and some of these cryptocurrencies to maybe give back a little bit more of those gains, but the longer term picture is still probably likely higher for these cryptocurrencies, as we eventually will get some kind of an ETF product and probably a cascade of ETFs in cryptocurrencies that really bring investors into those and boost the market value of those. We also saw shares of Hawaiian Electric, ticker HE, jumping 40% after pushing back on a lawsuit from the Maui County blaming the utility for its wildfires. Hawaiian Electric is down more than 60% from before those fires and really attracting investors on hopes of a triple digit score. Okay, so it's now down trading for about $14 a share. If it were to get back even up to about almost $30 a share, which would still be lower than it was before the fires, that would be 100% return. But I want investors to be careful here. Okay, I know at 40% one day pop and potential for another 100% a return is very attractive. Investors are going to be playing this, trying to get in before something like that. But Don't forget what happened to PG&E, but after those California wildfires. Okay, that ended in bankruptcy after PG&E was forced to pay out fines and settlement related to those California wildfires. You better know how much Hawaiian Electric can pay out, how much an eventual settlement might cost. So that's going to take some deep analysis into not only the legal risk and litigation in the case, but also financial statement analysis of Hawaiian Electric and how much can it afford before it just goes ahead and files bankruptcy, basically wiping out investors. Get your free report, The Stocks I'm Buying for the Next 30 Years, my forever stocks, with the link below in the description. Or click on the video to the right for my strategy for retirement investing that beats the 4% rule. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.